Welcome back to the deep dive. Today we're going to tackle something that I think a lot of people kind of put off thinking about,
Yeah.
long-term care.
hmm
And the big question we're going to try to answer is, should you insure for it or should you try to self-insure by investing?
Big question.
Big question. And we've got a great article to guide us from SCLUF Financial Group's Long-Term Care University.
It's a decision a lot of people wrestle with. I mean, we insure our cars, we insure our homes
Right.
because there's a potential for a large financial hit.
Yeah.
And long-term care is very similar, but often overlooked.
Yeah, and the article really hits home with some of the stats. Like, did you know that 7 out of 10 people over the age of 65 will need some form of long-term care?
Wow.
That's like saying you're more likely to need long-term care than to get into like a serious car accident.
Yeah, those are some pretty sobering odds.
Yeah.
And the costs are eye-watering.
Yeah.
We're talking about potentially needing help with everyday activities for years, maybe even decades.
Okay, so paint a picture for me, like in terms of costs, like today.
Yeah.
What are we looking at?
So today's numbers, a private room in a nursing home,
Yeah.
that can cost over $9,700 a month.
Wow.
Assisted living over $5,300 a month. And remember, these are today's prices.
Right.
Someone who's 55 now, when they need care, these costs could easily double,
Right. Yeah, that's what's scary, is that these costs are only going up.
only going up.
And then you factor in that the average nursing home stay is years.
Yeah, we're talking potential expenses exceeding $900,000 per person.
Per person.
Per person.
It's no wonder people get overwhelmed just thinking about it.
Right.
But don't worry, that's where this deep dive comes in.
Exactly.
We're going to break it all down, make it easy to understand, and hopefully a little less scary.
Yeah. And to illustrate the choices and their impact, the article introduces us to two fictional couples, both 55 and in average health,
Okay.
the Millers and the Smiths,
Love it.
and we're going to follow their journey as they navigate this very complex decision.
I like a little financial drama to keep us on the edge of our seats.
A little bit.
So let's meet our first couple, the Millers.
Okay.
They've decided to take the self-insuring route, meaning they're going to invest money strategically, hoping it grows enough to cover any potential future long-term care costs.
Right. They're starting with a combined investment of $20,000 and plan to add another $20,000 every year for the next 25 years.
Okay.
And they're optimistic about earning a 7% annual return before taxes.
Wow, that's a lot of discipline.
Yeah.
Putting aside that much money every year.
Yeah.
So what happens to the Millers after 25 years of diligently saving and investing?
Well, after 25 years, they've managed to grow their nest egg to $295,672
No.
before taxes, of course.
Before taxes.
That might sound impressive at first glance,
Right.
but here's where things get interesting.
I'm all ears.
That final figure is only about 1.5 times their total investment over those 25 years.
Uh-huh.
Now, remember those potential long-term care costs we talked about?
Yep.
Potentially hitting hundreds of thousands of dollars per person.
Yeah.
Suddenly, their self-insured fund doesn't look quite as robust, does it?
That's a good point. It seems like they're taking on a lot of risk, hoping that their investments grow enough to cover such a huge potential expense.
Yeah.
So let's switch gears and meet the Smiths, who opted for traditional long-term care insurance.
Right. The Smiths decided to transfer that risk to an insurance company.
Okay.
Their policy includes something called inflation protection,
Okay.
which basically means their coverage keeps up with the rising cost of care,
Right.
even decades down the line.
Smart.
Think of it as a built-in safeguard against those scary rising costs we talked about.
Yeah, that makes a lot of sense, especially when you consider how much those costs are projected to increase.
Yeah.
So what kind of benefits does their policy offer?
So their policy provides them each with a monthly benefit of $10,050 starting at age 80.
Okay.
And here's the key. It covers a combined 18 years of care.
18 years.
18.
That's a lot of peace of mind knowing that they're covered for that amount of time.
It is.
But I'm sure this kind of comprehensive coverage doesn't come cheap.
Well, you're right. There are costs involved.
Yeah?
They're paying a combined annual premium of $19,667 for a period of 10 years.
Okay, so let me do the math. That means their total premium cost over that decade is $196,670.
Exactly. But here's the kicker, and this is where the power of insurance really shines through.
Yeah.
The potential total benefits that they can receive, all tax-free, is a whopping $2,551,504.
Wait a minute, let me get this straight. They pay less than $200,000 in premiums, and their potential benefits are over $2.5 million.
You got it.
That's more than 12 times their investment.
It is.
I'm starting to see why the article leans towards insurance.
It's quite a difference, isn't it?
Yeah,
We often hear the word leverage in finance,
right?
and this is a perfect example of what that means. The Smiths are using a relatively small amount of money, their premiums, to potentially control a much larger outcome, their long-term care costs.
Yeah.
It's like using a lever to lift a heavy rock that you couldn't budge on your own.
Okay, that analogy makes it really click for me. They're basically amplifying their financial power with insurance.
Yeah.
But before we dive deeper into the pros and cons of each approach, I
Yeah.
want to hear from you, dear listener.
Yeah.
What are your initial reactions to these two very different paths? Are you Team Millers or Team Smiths?
We'll be right back after a quick word from our sponsors to unpack all of this and explore another fascinating option.
It's okay.
Hybrid life and long-term care insurance. Stay tuned.
All right, we're back and ready to dig into the pros and cons of each approach to long-term care planning.
Okay.
I have to admit, seeing those numbers from the Smiths insurance policy really got my attention.
Yeah.
So let's start with the Millers and their self-insuring strategy.
Okay.
What are some potential upsides to their approach?
Well, the Millers value flexibility and control. With self-insuring, they're calling the shots.
Mm-hmm.
They choose their investments. And if they decide they want to use that money for something else, maybe a dream vacation or helping their kids with a down payment, they absolutely can. It's their money, plain and simple.
Yeah, that makes sense. It's like a multi-purpose safety net, not just for long-term care.
Right.
But what about the downsides? What are the risks that they're taking on?
The big one is uncertainty.
Okay.
The Millers are essentially betting on their investments, consistently outperforming not only inflation, but also the rising costs of care, which can be unpredictable.
Yeah,
What happens if there's a market downturn right when they need that money the most?
that's a scary thought. It's like they're walking a tightrope,
Yeah.
hoping they don't lose their balance at the worst possible time.
Right.
It seems like they're shouldering a lot of risk.
They are. And that risk might be fine for some people,
Okay.
especially those who are comfortable with investing and have a high risk tolerance.
Mm-hmm.
But for others, it can feel like a gamble they'd rather not take.
Okay, so let's switch gears and look at the Smiths and their decision to go with traditional long-term care insurance.
Okay. Yeah.
The article seems pretty enthusiastic about this approach. What makes it so appealing?
The biggest draw is the potential for leverage,
Okay.
which we saw in action with the Smiths.
Right.
For a relatively small investment in premiums, they've secured a massive potential payout
Right.
that would be nearly impossible to replicate through self-insuring.
Mm-hmm.
It's like they've magnified their buying power
Okay.
when it comes to covering those future care costs.
Right, that leverage factor really stands out.
Yeah.
But what about the cost of those premiums? I mean,
Mhm.
some people might be hesitant to commit to those ongoing payments, especially if they never end up needing long-term care.
That's a valid point.
Mm-hmm.
You're essentially paying for peace of mind,
Yeah.
knowing you have that safety net in place even if you never end up using it.
Yeah.
It's a bit like paying for car insurance.
Right.
You hope you never have to use it, but you're glad it's there if
Yeah.
you need it.
Right. And with long-term care insurance, that peace of mind can be priceless, especially when you consider the emotional and financial strain that caregiving can place on families.
Absolutely. It's about protecting not just your assets, but also your loved ones from having to shoulder the burden of your care costs.
Now, before we wrap up, let's touch on that third option. The article mentioned hybrid life and long-term care insurance.
Okay.
What's the deal with that?
Hybrid policies are interesting because they offer a sort of two-for-one deal.
Okay.
You get the coverage for long-term care needs,
Mm-hmm.
plus a death benefit that's paid out to your beneficiaries if you don't end up using the long-term care benefits.
So it's like having a life insurance policy with a long-term care rider attached to it.
Exactly. And there are different flavors of hybrid policies to choose from.
Okay.
Some offer inflation protection to keep up with rising costs, while others provide lifetime coverage no matter how long you need care.
Okay, so lots of options to consider there. It seems like hybrid policies add another layer of complexity to the decision-making process.
For sure.
But at the end of the day, what does the article ultimately recommend?
Well, the article strongly favors some form of long-term care insurance, whether traditional or hybrid, over trying to self-insure.
Okay.
They argue that the potential benefits and financial security you gain from transferring the risk to an insurance company
Yeah.
far outweigh the costs.
I see what you mean. It's about acknowledging the very real possibility of needing long-term care
Right.
and taking proactive steps to protect yourself and your loved ones.
Exactly. It's not about being pessimistic. It's about being prepared.
So what's the key takeaway for our listener today?
While this article makes a strong case for insurance, The decision of whether and how to insure for long-term care is deeply personal.
Mm-hmm.
It's important to weigh the pros and cons of each approach.
Yeah,
Consider your own risk tolerance
right.
and think about what kind of peace of mind you're looking for. This isn't a one-size-fits-all kind of decision.
Yeah. I think that's a great point. There's no right or wrong answer. It's about finding the solution that feels right for you and your unique circumstances. But before we move on, I'd love to hear your thoughts. What stands out to you, dear listener? Are you leaning towards self-insuring or exploring insurance options?
We'll be right back after a short break to wrap up this deep dive and leave you with some final thoughts and resources to continue your exploration. Stay tuned.
And we are back for the final part of our deep dive on long-term care planning.
It's a complex topic, but hopefully you're feeling a little bit more informed, a
Yeah,
little bit more empowered.
absolutely. And while the article that we're looking at really advocates for insurance, it's important to remember that there's no one perfect approach for everyone.
No.
Yeah.
And choosing the right type of coverage, if you decide to go that route,
Mm-hmm.
requires careful consideration.
For sure.
It's not as simple as it's just saying, get insurance.
Right.
There are different types of policies,
Yeah.
various riders and options and factors that can impact your premium costs. It can feel like a maze, especially if you're not familiar with the ins and outs of insurance.
Right. And that's where a qualified financial advisor can be super helpful.
Absolutely.
I mean, they can help you navigate the complexities, assess your needs, recommend options that really align with your circumstances and your goals.
Exactly. Think of them as your long-term care, Sherpa,
Oh,
guiding you through the terrain and helping you avoid potential pitfalls.
I love that analogy.
Yeah.
So as we wrap up this deep dive, what's the one key takeaway you want our listeners to walk away with today?
Here's what I would say.
Yeah.
While the numbers presented in the article make a strong case for the financial benefits of long-term care insurance,
Yeah.
the ultimate decision is a deeply personal one.
Mm.
There is no right or wrong answer. It's about finding the solution that aligns with your values, your risk tolerance, and your vision for the future.
Yeah, I think that's such an important point. It's about making choices that really give you peace of mind.
Right.
Not just about your finances, but your overall well-being and the well-being of your loved ones as well.
Yeah. Couldn't have said it better myself.
Well, on that note, a big thank you to our listener for joining us on this journey into the world of long-term care planning. We hope you found it valuable, and we encourage you to continue exploring and asking questions. After all, the more you know, the better equipped you'll be to make those important decisions. Until next time.
Happy planning.